Welcome to First Mover, your first global look at today's action in the Bitcoin, blockchain, and digital asset space. I'm your host, Christine Lee. Joining me are my co-host, CoinDesk Managing Editor of Global Capital Markets, Lawrence Lewiton, and Executive Director of Global Content, Emily Parker. Good morning, Emily. Good morning, Lawrence.
Good morning.
Seeing some green shoots this morning. Let's take a look at the markets right now. Checking in on Bitcoin, the CoinDesk Bitcoin price XBX index is currently at $44,273. Bitcoin shooting up about over 4% over the past 24 hours. The CoinDesk Ether price ETX index is at $3,112, over that $3,000 level, now also making an advance about almost 6%. And the DFX CoinDesk DeFi index is at 300, also seeing that skyrocket at almost 7%. The most reliable reference prices for institutions since 2014 are now published under the CoinDesk brand, trusted globally as a leader in crypto news, events, and data. So when we look at the crypto market, it seems to be that they're responding, and I would assume, Emily, to this Ukraine-Russia border tension that's been
mean, even that assumption, which many people do seem to assume, is quite interesting because it sort of assumes that crypto is acting more like a risk asset than a safe haven asset. And that kind of goes against the fundamental philosophy of crypto, in that it is supposed to be a safe haven from the tumult of, global political and economic events. So it's if that's true, it just begs some questions about the role of crypto in general.
Yeah, so Russia says that they are pulling back some troops, but some drills continue. Lawrence, is that having an impact on the market?
Yeah. I mean, look, to Emily's point, the whole idea that crypto is somehow a safe haven is just kind of like a bit of nonsense that's been perpetrated for years by people who are heavily invested in crypto. It's not a safe haven necessarily. It's still a risk-on asset until otherwise proven. And that's what we're seeing right now. And it's not just Bitcoin, it's ETH, it's the entire CoinDesk 20. Everything is up. I mean, this is clear that people are saying, okay, the world is calming down a little bit. We probably won't see mushroom clouds over Kiev. So that's pretty cool. Let's go and throw some money into crypto again.
Yeah. Meanwhile, up north of the border, Prime Minister Justin Trudeau invoking the Emergencies Act to freeze the bank accounts of funding the Freedom Convoy truckers who are protesting strict COVID mandates. So civil liberty groups have mixed reaction. Yeah, some say that it's responsible, good strategy. Others, like the Canadian Civil Liberties Association, warning that the act should not be normalized. It's supposed to be used to protect the nation's sovereignty when all other laws had been exhausted. Bitcoiners are also pointing out that with cryptocurrencies, this would not be as much of an issue. Governments can't freeze your bank accounts as easily, but we're seeing, of course, geopolitical tensions around the world simmering, continuing on. Let's dive deeper in the markets with our Crypto Markets Update. The Crypto Markets Update is brought to you by KuCoin, the best place to find the next crypto gem.
Lots of excitement in the world, and joining us now to discuss the crypto markets, of course, is Seth Ginns. He's managing partner and head of liquid investments at CoinFund. Welcome, Seth. Good morning.
Hey, thanks for having me again.
Thank you for coming on. So that's it, right? The bear market's over. It's all done. Let's go rally. Is that it?
Off to the races.
Party on?
No, look, to what you were saying, we think of crypto as risk-on assets. There's an equity-like diversity here. This is technology investing. I think there was a really interesting change in the markets that happened a few weeks ago, 2 weeks ago, with the payrolls number. We saw that as a regime change. When you had the market that thought that the Fed was going to make a policy mistake, tightening into a slowing economy, with Omicron having slowed the economy, everyone was talking about 4Q of 18 as being the parallel. And what we saw with the payrolls number was the economy's actually pretty strong. Things are not slowing as much as expected, which meant there's no reason to think that the Fed is going to move away from being data dependent. And I think today you see PPI coming in a little bit stronger, and the market just shrugged it off. Why? Because the Fed's going to be data dependent at this point. If they see things slowing, they're going to back off of tightening. If they see things continuing to remain strong, they're going to try to fight inflation. So this looks a lot more like 2017 and the early part of 18 in equity markets, where we hit a new high right at the beginning of 4Q, just before everyone started getting worried about a policy mistake. So we feel really good. Think we're in a fairly constructive risk-on regime right now, and that the payrolls report was the turning point.
So, Seth, just to kind of dig into that a little bit, and looking at just sort of global political events, you're saying Bitcoin is a risk-on asset or is acting like a risk-on asset. But as Lawrence and I were saying early on, it kind of goes against sort of the philosophy of crypto in a way, because it's supposed to be a safe haven or just a refuge from the turmoil of like the real world. So I guess my question is, do you expect Bitcoin to just continually act this way, or will there be a point where Bitcoin will start to fulfill its promise as being more of a safe haven?
So it's actually interesting. We've been seeing much more dispersion in crypto markets with Bitcoin in kind of a broken down state under the 200-day moving average than what we historically have seen. So there's actually, with that dispersion, with that divergence, you could have Bitcoin and the rest of crypto acting in different ways. So crypto broadly, today, acting risk on, we're seeing dominance come down a little bit. So the rest of crypto is outperforming Bitcoin. But we could certainly see Bitcoin act as a safe haven. My guess is the rest of crypto would not act as a safe haven if we were to have a re-escalation of geopolitical tension. So I think there's not the real strength of what we're seeing is that we're seeing assets in crypto trade based on their fundamentals rather than trade as this monotonic asset class that has to move in lockstep with Bitcoin. And that's a real sign, I think, of the maturation of the asset class and the diversity of investors that have started to engage in this space. And a lot of those investors are technology investors that are looking at this as the next wave of technology investing.
It's interesting you say technology investors. I wonder if you're hearing anything from sovereign wealth funds. Singapore's state investment fund, Temasek, one of the largest investors in the world, just pulled out of Coinbase, their investment there, just over $2 million. But are you hearing chatter from or talks from sovereign wealth funds or, pension funds? Can you name any names or say what they're interested in, Bitcoin, Ether, or alts?
Yeah, all of the above. Sovereign wealth funds, defined benefit pension plans, and all of the institutional investors in between. I'd say last summer was really the catalyst. I think it was a combination of having seen the move up in the asset class earlier in the year, many of them having missed it. Temasek was very early to the space, so they didn't miss it. But a lot of others were watching it, doing research, saw the move up, and then on the pullback said, you know what, now's the time to start doing a deeper dive. So we saw IDD, ODD, so investment due diligence, operational due diligence, really start to kick up over the fall. And institutional engagement from a funds flow perspective. And this is what we're seeing. I'm sure it's happening broadly in the space since the beginning of the year. So real engagement. I think another component, though, and I believe we talked about this a bit the last time I was on, the regulatory de-risking. So we're still going to have headline risks on the regulatory front, but we think we're going through a normalization on the regulatory front where you have senior senators saying crypto is here to stay. It's technology innovation. We want to keep it onshore. And that means working with the industry to come up with a thoughtful regulatory regime. And that engenders confidence on the part of institutional investors, on the part of traditional businesses, whether financial businesses, media businesses that say, you know what, it's actually okay for us to engage with crypto. So we're seeing some really good signs on that front.
Seth, you brought up again the idea of this is a long-term technological investment. Nonetheless, besides Bitcoin and ETH, there are all these other altcoins, and they're all divided based on what they do. So are there any subsectors or sectors that you think are promising right now or well valued at the moment where they at least have some potential upside for investors?
I mean, we think that over time there's going to be a handful of challenger base layers that end up being quite large in the trillions or tens of trillions. Right now, all of the challenger base layers beyond Bitcoin and ETH are much smaller, less than 50 billion. So that's kind of the de-risked part of the market where you don't have to bet on any individual application layer protocol to be a winner. You're betting on the base layer, the operating system technology, being a place where people want to build and where users want to come. Now, the counter to that would be we're also very bullish on interoperability and cross-chain solutions. So the degree to which any individual ecosystem ends up winning versus a layer on top that spans many is an open question. But right now, I'd say base layers are quite interesting.
All right, Seth.
Speaking of interoperability, there seems to have been there were a couple of controversies recent weeks, with Wormhole and what have you. Do you think that affected people's enthusiasm for that sector, or do you think that's just up in the road?
I think the industry handled it really well. You saw a backstop of the fund. Solana is now above where it was before the exploit. So I think it was a bump in the road. Cross-chain interoperability is very much a part of the future that we expect to see. So I think we're going to see a lot more of that in the coming weeks and months.
Seth, I always like
interoperability, not hacks.
Well, you never know. Every week is a
see
surprise.
Some of those too.
But Seth, I'm wondering. I always like to end things off on a price prediction. So, any price predictions for Bitcoin next 3 to 6 months?
Short-term predictions are always hard, but I'm very bullish on Bitcoin for this year. I think we'll likely see an all-time high later this year. Whether that happens in the next 3 to 6 months, I'm not sure.
All right, Chris. Thank you for your insights. That was CoinFund Head of Liquid Investments, Seth Ginns. Coming up, GameStop, Reddit. Remember that movement? What we have learned 1 year later. We'll figure that out next. Live look at Bitcoin. The CoinDesk Bitcoin price XPX index is currently at $44,393. The Bitcoin shooting up over 4% over the past 24 hours. The CoinDesk Ether price ETX index is at 31.29 ETH, also skyrocketing 5.8%. And the DFX CoinDesk DeFi index is at 300. DeFi taking off about 7%.
The CoinDesk Spotlight is brought to you by Nexo, the place to earn on Bitcoin, Ethereum, and more.
So we're all old enough to remember the saga of GameStop and Reddit when a crew of retail investors on Reddit, Wall Street Bets, supposedly had a big triumph over the big bad guys of hedge funds. So basically, the narrative is that this group of retail investors basically triumphed by forcing a short squeeze and causing big hedge funds to lose money. Our next guest, Spencer Jakab, a reporter at the Wall Street Journal, has a new book out that argues that narrative is fundamentally flawed. His new book is called The Revolution That Wasn't: GameStop, Reddit, and the Fleecing of Small Investors. So welcome, Spencer.
Hey, thanks for having me.
So I had the pleasure of reading your book this weekend. It's a really fascinating read. And I would just love for you, for the people who have not had a chance to read it yet, to just break down your central thesis here. You're basically saying that this is not how the media portrayed it. It was not a triumph of retail investors. Actually, Wall Street kind of had the last laugh. Can you just explain, what you mean by that and what evidence you have to support it?
Sure. Well, I put it in historical context because, Wall Street is more than 2 years old, right? Wall Street, or let's say stock markets, are centuries old. And there have been lots of episodes of people getting excited individually or as a group and thinking that they could beat the man, that they could beat the street, that they could beat the house, and plowing a lot of fresh money into the markets, and entering it and then leaving disappointed. And this is just one more of those. The basic thesis was in saying that it's a revolution is that it was a twofer, that you had a bunch of people who wanted to make a lot of money and also wanted to give Wall Street a black eye in the process. And of course, the headlines at the time certainly made it sound like that. You had hedge funds losing billions of dollars. And so you had some individual players on Wall Street who had a very bad week, a very bad month. And that's undeniable. But what really happened is that Wall Street made a ton of money in the lead up to the squeeze and in the aftermath of the squeeze just because of the sheer level of activity. And as a group, a lot of these meme stock traders got in very high and either are still holding or got out or are embittered and have these theories that they need to have diamond hands and that it's just going to come next week, next month. There's going to be a big squeeze and they just need to be in there based on really no solid evidence at all.
So, Spencer, that makes a lot of sense. And I think your book actually details quite nicely how there was a lot of profit on Wall Street, despite this narrative that Wall Street, collectively got a black eye. But I'm just curious, on the retail investor side, what evidence do we have that a lot of retail investors were actually hurt by this, right? Because that to me was the central narrative, that this was like the triumph of the little guy. Do we have stories or evidence that a lot of retail investors really lost a lot of money in the whole GameStop so-called revolution?
Well, we have tons of anecdotes. Let's not forget that GameStop, even today, and AMC and the other meme stocks are still elevated relative to where they were before. So there's still some air to come out of them. Also, those companies have gone out, a couple of them, and raised in excess of $1 billion from their new enthusiastic shareholders. And so it's all of a bit of a jumble and difficult to disentangle. AMC went out and raised over $1 billion, even as its executives sold personally over $90 million in their own shares. How do you disentangle who won, who lost? If you're just looking at something like Reddit or TikTok or whatever, and you hear people talking about it, the people who made money are going to be, in any of these cases, in any kind of mania, whether it's .coms or whatever, yeah, I saw it and I got out, or I got in at a really low price. You don't hear the people as much who say, yeah, I bought GameStop at $420 on Thursday, January 28th, and now I'm sitting on a 75% loss. So those people are kind of licking their wounds and either sold or didn't sell. But if you look at it's just the amount of money pumped into options premium, as I explained in the book, options played a really big role in this. You had tens of billions of dollars in options premium in GameStop alone. If you look at the stocks that saw a lot of options turnover in the stock market last year, you have these big companies like Apple and Nvidia, and then GameStop is in there. What the heck? GameStop is like a tiny company. It was worth $230 million at the beginning of this saga. So it does not belong on that list at all. And tons of money was basically kind of squandered by investors trying to sustain a gamma squeeze in the stock.
So, Spencer, welcome. One of this story isn't over yet, as you point out, and it's an ongoing saga. It turns out, though, that news just last week that the Feds paid a visit to Andrew Left, who comes off kind of sympathetically in your book. Does that change your view of Andrew Left, of the Melvin Capital, et cetera, knowing that, okay, there seems to be some sort of activity, at least from the Feds, investigating what they're up to, or there was back then, which could explain why we stopped seeing those reports coming out of Citron, et cetera. Do you think that does that change how you view it now that happened, that news came out after the book was written?
No, it doesn't. I have no idea why they paid him a visit. It could be related to GameStop. It could be related to any of the other hundreds of companies that he shorted. He also goes long stocks. I really have no idea. I mean, I do mention in my book, I mean, short sellers were sort of cast as the villain on Reddit and elsewhere, and they historically have been cast as villains. You can go back to through the entire history of stock markets, going back to the Dutch in the 1600s, and short selling was periodically banned because how dare these people bet that stocks that most of us hope will go up, that they'll go down. But short sellers play a vital role, and especially for inexperienced retail investors, they play a very vital role because short sellers just generally, and I'm not talking about Andrew Left or casting him as a hero or casting Gabe Plotkin or Melvin Capital as a hero or any short seller for that matter. But short sellers, you can, there's two things if you're a long only investor that you can do with a stock. You can buy it or you can not buy it. So you can vote for it or you can abstain. And short sellers represent the only no vote, the only vote that something is overpriced, perhaps even fraudulent, and is going to go down. Now, if you're an inexperienced retail investor, and this is a story of in excess of 10 million mostly inexperienced retail investors who got into stock trading in the sort of year and a half before this episode, you need somebody to basically be able to bet against a stock to make the price more correct because you're not necessarily equipped to do all the forensic accounting and the valuation work and know if a stock is properly valued. If you don't have people out there who are willing to stick their necks out and be short, then then prices are going to be more wrong. And there is episode after episode of that happening. So, whatever Andrew Left did or didn't do has no bearing on the basic thesis of the book and the role of short sellers at all.
Spencer, I wonder if you can weigh in on the parallels you see with cryptocurrencies and the whole digital economy and the consequences therein. And if you could weigh in on, Elon Musk, Doge as well. On the one hand, they could be considered dangerous, but at the same time, great for mainstream adoption.
Sure. Elon Musk makes a couple of cameos in this. He jumped in and kind of fired up the crowd at a critical point during the heart of the meme stock squeeze. And you had a few different millionaires and billionaires coming in, and you had a lot of financial influencers also playing a role in the meme stock squeeze. Some of them did it to make money. In Elon Musk's case, I mean, he was the richest man in the world at the time. He didn't do it personally to make money. He did it really, I think, for attention, because attention is the currency of social media, and he wants to be adored and came out there. How does it play into cryptocurrency? I think if you look at these meme stocks that were valued in some cases, they still were stocks, right? Stocks, you still can say, I think this company is worth this much, and its assets and its intellectual property and its future cash flows are worth this much. And then they were worth 10 or 20 or 100 times what analysts said they were worth, which is why all the analysts sort of either gave up covering them or had sells on them at the time. They couldn't actually make an argument. Cryptocurrencies are a little bit different because it's very difficult to do a DCF model on Dogecoin or whatever, right? Because it's not a company, it's an asset, and so it's much more sort of an art than a science. But you did see a lot of the speculative enthusiasm merge in the months after the meme stock squeeze from meme stocks into things like Dogecoin. And if you look at Robinhood, which is a very big player in my story, Robinhood's profits went from being primarily driven by people buying shares and options and in meme stocks and other things, and going the following quarter, they made a lot more money in Dogecoin than on these meme stocks. So I think that if you drew a Venn diagram of people who were excited about meme stocks and Dogecoin, and even people who profited from one or the other, there is a fair bit of overlap. And in that sense, there's a similarity.
So just going back to your central thesis here, though, I mean, it's hard not to read your book and see a lot of echoes of the crypto world, right? So like this whole idea behind GameStop, or this whole narrative behind GameStop, is you had all these little guys basically driving up a stock just because they believed in the stock. That was the main reason, right? It was kind of like a totally sentiment-driven phenomenon, right? At least at that period. And then you switch over to Doge and Sheeb, stuff like, coins like that, you have a similar narrative, right? That, these are basically being driven by sentiment, and that, they're decentralized, and it's like the crowd is driving up the price, right? And a lot of people are celebrating that and saying like, okay, well, somehow we feel excluded from the traditional market. So this is our chance to kind of like get in on the ground floor and basically like, along with my comrades, drive up the price of an asset. But you're saying that in the case of GameStop, that's actually not really what happened, right? That's just what it seemed like on the surface. Would you say that applies to cryptocurrency as well? Or are the sort of like the big guys or the whales or the traditional finance, will they also get the last laugh when it comes to crypto as well?
Sure. Well, let me clarify. So they got into the meme stocks and GameStop specifically, not because they did a valuation and then there was some cerebral rational argument that no, GameStop is really worth $1,000 a share, not $4 a share, right? Nobody was really making like any kind of sound argument. What they were saying was that, it was like, we're all going to buy. You have all these funds that are short, and they correctly identified a vulnerability on Wall Street. So there was like a lot of hubris on Wall Street where they had sold these stocks short to an extent where they had such a narrow exit that they were waiting to be ambushed. And they weren't paying attention to what people were talking about on Reddit or on social media. And so they got completely blindsided when this crowd rushed in, and they were completely blindsided by the strength of the crowd and the kind of the virality of the whole thing. And that's why they lost so much money, and that's why the prices went up so much briefly. And so I think you're right that there's some sense in the crypto world as in the meme stock world, and like I said, probably a lot of overlap in terms of the personalities involved, and certainly the demographics involved, that this is our thing. There's kind of two sets of rules on Wall Street, and we're being messed over, and we don't really trust traditional finance. This is a generation primarily that their formative experiences, even though they might have been teenagers or children, were during the great financial crisis, and Wall Street's a crooked place. And in the meme stock squeeze, they said, we're going to hurt Wall Street and make money in the process. And I guess in the crypto world, it's this is our thing, and Wall Street doesn't get it, and we're going to get it on the ground floor, and this is the future. So absolutely, I think you're right that there are parallels in the sentiment there, and there are also parallels. Hate to rain on your parade, in the sense that there are other people who are just happy they showed up, right? There are no commissions now for stocks, but we know now there are all these disclosures about how payment for order flow works, that there are people making billions of dollars off of the kind of the support network of all these trades happening and all these options trades happening, right? So the people who really got rich off of this primarily were already on Wall Street, and they were just middlemen. And the transaction costs in crypto, as you all know, are a lot higher. And there are people who primarily act as middlemen. They're not risking their capital. They're out there basically facilitating the transactions, and they're happy about the level of enthusiasm about crypto. And there are lots of new billionaires, people who weren't anywhere on the map 5 years ago, who got rich not because they owned crypto and took a risk, but because they facilitated all these transactions in crypto. I don't really see a big difference between those two.
So you talked earlier about the ambushing of these short sellers. It obviously, they didn't see the stimulus checks coming necessarily. Do you think that the stimulus checks ended up causing more economic damage than helping? Obviously individual stories, people needing that help. But do you think from a macro 10,000 foot view, it caused more harm than good? And is that necessarily something that needed to be reconsidered? Also, you end your book kind of positive on the individual investor. Does that apply to crypto?
So two things. It's beyond the scope of my book to say whether or not stimulus checks were good. I think they definitely came at a convenient time. You had a surge in the unemployment rate. You had this massive dislocation. And you didn't know back in March 2000 how long this pandemic would last. We could have been locked down for months and months, right? So the stimulus checks were, not perfect, and landing in people's pockets who didn't necessarily need the cash, especially young people who had a lot of extra time on their hands, had seen their social lives kind of shrivel or disappear. That just poured fuel on the fire of all this opening of accounts. I think that's not disputable. I do see a positive in the story in the sense that you had lots of people get on the ladder of Wall Street. I think there's three different outcomes there. I think some people are going to say, like, you know what, this was a little bit dumb, but now I have an account. I understand how to buy and sell a stock, and I'm going to sort of take a much more longer term approach, because you can't really build a nest egg in this country unless you have your own business or something like that without investing in the stock market or the bond market or something like that. And so it's good that they have their feet on the ladder. I think a lot of those people are going to be bitter about their experience and still see Wall Street as crooked, and they're just going to sort of try other stuff. And I guess some of those people are going to primarily play in arenas like crypto. I'm not a fortune teller. I can't tell if crypto is going, how much of an asset class it's going to be in a year or 5 years or 10 years. And we're talking about decades here. Crypto wasn't anywhere 10 years ago. I don't know where it's going to be in 10 years or in 40 years when these people are nearing their retirement. If you think that it's a great asset to invest in, and that it is an investment, that it's not a technology, but just something that you buy and then hold and then sell, then that's fine. Then I guess they'll do okay. There are a lot of reasons to question that. I certainly wouldn't put a very large chunk personally of my nest egg into cryptocurrency. I haven't put any, but I wouldn't. Even if I did, I wouldn't make an enormous bet on that. Just like I wouldn't make an enormous bet on any one technology in the stock market or any one stock. It's important to be diversified.
All right, Spencer, fascinating discussion. Congratulations on the book, and thanks for coming on the show. Folks, if you want to dive further, you can buy the book now on Amazon, The Revolution That Wasn't, GameStop, Reddit, and The Fleecing of Small Investors. That was Spencer Jakab. All right, coming up, we'll be talking about the latest update from Bitfinex and the money launderers therein, checking in with CoinDesk Global Policy and Regulation Managing Editor Nick Day with more. Welcome back. Time to check in with CoinDesk Global Policy and Regulation Managing Editor Nick Day, who's also the editor of CoinDesk's The State of Crypto newsletter. Good morning, Nick. All right, so at one point, the wealthiest rapper in the world, definitely most gangster, has now been released from jail by a federal judge, Razzle Khan, I'm talking about, of course. Her husband, partner in crime, Dutch Liechtenstein, will remain in jail in connection to the Bitfinex hack, laundering of over $4.5 billion worth of BTC. What are the details, Nick?
Good morning. Yesterday, yeah, you're right. A federal judge did release Heather Morgan, or will release Heather Morgan ahead of a trial on allegations that they conspired to launder. Frankly, it's like over $4 billion worth of Bitcoin overall, 3.5 billion of which were seized. Liechtenstein will remain in custody, and Morgan will be subject to, fairly strict set of restrictions. No internet access, has to be, confined to, I believe she has to stay in her parents' home. So she will not be able to, just hop back on YouTube and resume making her videos or anything like that. But yeah, right now they are going to remain in custody. This was part of the pretrial detention hearing yesterday, where prosecutors also laid out, a couple more allegations, including the idea that the defendants have access to another, $300 million or so worth of Bitcoin that they haven't been able to track down just yet.
I'm personally disappointed she won't be able to go on stage anytime soon. I was looking forward to buying some tickets to that. But speaking of Bitfinex, let's talk stablecoins. What's going on?
Yeah, so in just a few minutes, I think, the Senate Banking Committee is going to begin a hearing on stablecoins. It'll be just like last week's House Financial Services Committee hearing. The sole witness will be Deputy Undersecretary Nellie Liang of the U.S. Treasury Department. She worked on the President Working Group for Financial Markets stablecoin report, and that's going to be the key focus. And, just like last week, I don't think we're going to be seeing any specific legislation today. I don't think we're going to be seeing, anything too specific in terms of, even, legislative ideas. I think it's going to be more kind of a conceptual, what are the things we can do sort of hearing. And, when and how that will lead to legislation is still kind of up in the air. we are seeing on the House side, Representative Josh Gottheimer of New Jersey released a draft bill just today for stablecoins, basically arguing that they should be insured at the federal level. Sort of like I think you would say an FDIC insurance account, for example, to protect consumers. So a lot of discussion happening around this. We're still waiting to see how that discussion will lead to actual, legislation or even, regulation from the agencies themselves. But it's definitely an escalating conversation.
Well, I have one more RazzleCon question, Nick, for you, but I'm wondering, why did the judge decide to be more lenient on her and let her release versus her husband, Dutch?
So what seems to have happened during the hearing is, or this actually happened even during the first pretrial detention hearing. There was one in New York last Tuesday, basically to decide, whether or not the two would have to remain in detention before going to DC yesterday. Where the narrative that seems to be emerging is that Ilya Lichtenstein was the kind of, mastermind behind the Bitfinex hack, or not the hack itself, but rather the laundering of the funds from the hack. And Morgan was just kind of caught up in all this. And this seems to be a narrative that has, enough sway, even in court, according to, our colleague Cheyenne Lagone, who was at the hearing. Lichtenstein said that Lichtenstein's attorney said that he would be willing to stay in and not take the fall, but the implication was that he'd be willing to kind of take the fall for all this. So that's at least a narrative that the defense seems to be trying to craft right now, and whether or not that will stick through the hearing or through the actual trial remains to be seen.
Interesting, and I see the prosecution's definitely trying to make it that they were a Bonnie and Clyde duo. They did this together, and she had her own business that was accepting in Hong Kong. I understand that was accepting funds from these Bitfinex stolen funds. All right, Nick. More to that in the coming weeks, I'm sure. Thanks for joining us. That was CoinDesk Managing Editor of Global Policy and Regulation, Nick Day. Let's check in with Crypto Twitter for our tweet of the day. This one is from Nicholas Weaver, a lecturer at Berkeley, tweeting, one overlooked detail in the RazzleCon arrest: almost all the money went through Alphabet, using it as a mixer. The feds were able to see through this because they seized Alphabet. It's amazing how even years after, darknet market seizures pay dividends to the feds. And just thinking, the government can't freeze your bank account, but they can make things difficult, track you, and eventually seize it in terms of Bitcoin. So
it's all on the blockchain, everyone.
It's all on the blockchain. That's it for First Mover. Thank you, Emily. Thank you, Lawrence. I'm your host, Christine Lee. Tomorrow I'll be at ETH Denver, so hit me up at Christine News. Also, meantime, check out The Hash at noon Eastern and All About Bitcoin with me at 3 o'clock. You're watching CoinDesk TV. Also, next up, stay tuned for the daily forecast to see what's happening in the Asia crypto markets.
Bitcoin is outperforming tech stocks. Find out why. Welcome to the Daily Forecast, February 15th, 2022. I'm Angie Lau, Editor-in-Chief of Forecast, covering all things blockchain. Well, some say Bitcoin is becoming just another tech stock, but its recent market performance might just have investors thinking, maybe not so fast. We're going to take a look at that story and a whole lot more coming up. Let's get you up to speed from Asia to the world.
Join thousands of NFT traders who already start their day on CryptoSlam.
Well, let's kick off with what's happening around Asia today. First up, in Hong Kong, its internet security watchdog says NFTs and the metaverse are a must-watch security threat this year. Sound familiar? China. The government-run Computer Emergency Response Team Coordination Center says information security for NFT and metaverse-related networks is a key risk due to the huge volume of transactions and data exchanged. Its report goes on to warn that criminals may try stealing sensitive user information as the value of cryptocurrencies grow. The agency's concerns were raised as Hong Kong experiences a boom in both the NFT and metaverse industries, with traditional auction house Philips launching a Valentine's NFT sale just this week. But it also toes the China party line on NFTs, and it makes one wonder when those policies might converge. Meanwhile, over in Singapore, DBS, the largest bank in Southeast Asia, wants to launch a retail digital assets trading desk by the end of the year. The move, announced by CEO Piyush Gupta, follows the bank's current DBS Digital Exchange, or DDX, that brought in almost $600 million in trading value in the last quarter. Now, DDX is currently a members-only exchange serving corporate, institutional, and accredited investors, as well as family offices. And now the bank says it plans to open up its business to a larger pool of customers, like retail investors. However, just last month, Singapore's central bank issued guidelines over promoting cryptocurrencies, saying the general public should not be encouraged to invest in them. Still, a tension between what's good for the goose might not be good for the gander. Well, we shall see. You can find those stories and a whole lot more at forecast.news. Over to the markets now. When it comes to tech stocks, could Bitcoin rule them all? Well, according to data from Finbold, it's looking that way. Bitcoin has outperformed the top 6 tech stocks over the last 30 days by an average return on investment of over 15%. So does that throw cold water on the thinking that there's a growing correlation between the price of Bitcoin and the leading tech stocks? Forecast's Lachlan Keller reports.
With institutional investors moving into the space, it had appeared as though Bitcoin's price was becoming more correlated to traditional markets. However, recent moves suggest that tech stock prices may not be that closely linked. As the US inflation rate reached a 40-year high of 7.5%, tech stocks wobbled, with investors concerned about the outlook for growth as Fed rate hikes loom. Meanwhile, Meta shares sank 25% in one day earlier this month after it revealed its first ever quarterly decline in daily user numbers, with one expert telling Forecast that raised questions over the business's long-term viability, especially in terms of advertising revenue. Andrew Sullivan says that in comparison to tech stocks, the underlying factors for Bitcoin have not changed, and that its price pullback at the end of January actually put it more on people's radar.
Whenever you sell something off, you know these guys are going to be looking to put their money back into something else. We saw some of that money obviously going into treasuries, but I'm sure a lot of that money was looking for other alternatives, and Bitcoin would probably been attractive at that stage.
Going forward, Sullivan says it's keeping watch on what happens when the Fed makes its first move.
It would be interesting then to see how Bitcoin and some of the other cryptocurrencies react, because it'll be the first time we've really seen them react to rising interest rates, because it's not a phenomenon we've known whilst Bitcoin's been around.
However, Sullivan says with more institutional money getting involved, Bitcoin's price volatility will dampen longer term. For Forecast, I'm Lachlan Keller.
DAOs are all the rage these days, the decentralized autonomous organizations that are managed using smart contracts rather than a traditional hierarchical structure. And that means you join when you buy the tokens, and you get to say what you want and how decisions are made. But where are they headed next? Kelvin Lam, CEO of Lithium Finance, is here with the DeFi download. Good to see you, Kelvin.
Always a pleasure, Angie.
Okay, DAOs, are you part of it? DAOs are being used to raise money, and it's just an incredible thing to see. And since they run on code, its members can directly participate in their governance. Why do you think this resonates with the marketplace? This is really, really picking up steam.
They're basically companies or organizations running on the blockchain. The difference is that they're not governed by company articles or bylaws, but smart contracts and computer codes, like you said. In a company, shareholders would come together in general meetings, would vote on major decisions, right? But the day-to-day management, a lot of things are delegated to the board of directors and management. So sometimes these decisions may not always be transmitted and executed correctly, and that creates agency problems. With a DAO, the entire chain of intermediaries, board, managers, and everyone could effectively be eliminated. The members will be managing the organization directly, leaving the execution to the smart contracts and the codes. That gives you full transparency in a decentralized world, and hopefully eliminating all the agency problems. So that could be incredibly empowering when a DAO is implemented in an efficient way for the right use cases.
We've seen DAOs that raised money to bolster Julian Assange's legal defense, another that came together to bid for a rare copy of the U.S. Constitution. It's almost like going in with an investing syndicate with your Facebook group. What are the pros and cons here?
I think of those examples are very similar to how people would incorporate entities in the real world to undertake investments or engage in lobbying. And in fact, since the intention of joint stock companies, people have been using these platforms for all sorts of economic and other interests. And just last year, the state of Wyoming passed a law to legally recognize DAO could be a separate legal entity for whatever purposes. And in the legislation, the state thinks of a DAO just like any other LLC or business entity, but that they use smart contracts to manage and operate themselves. So I think it's really a natural development that these DAOs bring people and economic power together.
Those are the pros, but there are also cons. Increasingly, we're seeing voter apathy, and the recent Constitution DAO's failed bid to buy the original U.S. Constitution also highlighted the problem of what to do with the funds and how to actually return them to the members when the original reason for the DAO failed. What are your thoughts here?
The smart contract was set up in such a way that the members of the DAO, of the Constitution DAO, will be able to surrender the tokens and to obtain refund in situations like this. And it's actually what's been happening. Their members are being offered the choice of getting a refund, net of the gas to transaction fee, of course, or retaining the token in the DAO. And for those who prefer to stay with the organization, these staying members will vote and decide what the DAO is going to do with the funds. So in that respect, I think the Constitution DAO has been a successful implementation. I feel that the real problem perhaps is with the gas to transaction fees involved, which could be at this time disproportionately or prohibitively high especially for members who contributed a smaller amount but looking to obtain a refund.
Lots to consider as we move into this brave new world of DeFi and DAOs and all the rest. That is the DeFi download for you this week. Kelvin, thanks so much for this. And that's the daily forecast from our vantage point right here in Asia. For more, visit forecast.news. I'm Forecast Editor-in-Chief Angie Lau. Until the next time.